Second, we pay very little attention. We don't pay any attention to capital flows. In other words, we don't really care who's buying or selling any security. Somebody is buying or selling each one. So obviously, there's, you could focus on the buyers, you could focus on the sellers, but you can say now that there's $20 billion in a month or so going into equity funds and all, but it doesn't make any difference to us. All we're interested in is what the business is worth. And what people are paying attention to in terms of capital flows or whatever, or market signals, or whether the Fed's going to move, that all changes. You remember 10 years ago it was M2 that every whatever day of the week it was, what's M2 this week? I always thought of having a mystery, about whatever happened to M2 or something. But there's always something that people are talking about. There's so much time to fill with chatter, and pages to fill that they write about all these things that to us don't make much difference, because we don't care if the market closes for the next 5 years. We care how much Coca-Cola is sold 5 years from now, and what percentage of the world market they have, and what they're charging for it, and how many shares are outstanding, and that sort of thing. But we don't care who's buying or selling it in the least, except we like it when the company's buying it. The same way with Gillette, we care about whether people are trading up in the shaving experience. So capital flows and all of those macro factors that people like to write about a lot just have nothing to do with what we do. We're buying businesses. And I really think it is not a bad mindset whenever you buy a stock to say, would I be happy buying this stock if the market closed for 5 years? Because then you're buying a business if you say yes to that. If you don't say yes to that, you may not be focusing on the proper thing. By its nature, the U.S. is running a substantial trade deficit, merchandise trade deficit. If you buy more from the rest of the world than you're selling them, which is what happens when you're running a trade deficit, you have to balance the books. I mean, they get something in exchange, and what happens is they get some sort of capital asset in exchange. They may get a government bond, they may get a piece of the U.S. business or something, but the key thing in economics, whenever somebody makes some assertion to you about economics, you always want to say, and then what? In fact, it's not a bad idea to say that about everything in life, but you always have to say, and then what? So when you read that the merchandise trade deficit is $9 billion, what else does that mean? Well, it means that somehow we have to have created $9 billion of capital assets, claims on our production in the future, with somebody else in the world. So they have to invest. They don't have any choice. When somebody says, won't it be terrible if the Japanese sell all their government bonds? They can't sell all the government bonds without getting something else in exchange. They'll get some other American asset in exchange, because there's no other way to do it. They can sell it to the French, but then the French have the same problem. So trace through where the transactions go anytime someone starts talking about one specific action in economics.